Hello, everyone. Don Garman here from Mirador Capital Partners here again. Happy belated Thanksgiving, and here we go, leading into Christmas and the December holiday season, soon to be underway at the end of this week. I thought I would take a moment and check in. We'll be short and sweet today because, in some sense, not a ton has changed since we last spoke. I will share that the Thanksgiving week was revelatory in that I came across many people who I had not seen in a while through one experience or another. And I found out many more of you watch this periodic update than I ever knew. So slightly terrifying, but I also appreciate that many of you shared that you get whatever value you do out of these. And so I want to keep updating you on our narrative as we come out of 2022 and what we would all regard is perhaps the year everyone expected to have in 2020 and didn't, and maybe even again in 2021 and didn't. And of course, we got the tsunami, as I've referred to it, in 2022, delivered by the Fed with 7, soon to be potentially 8 or 9 rate hikes this year, which caused valuations across both of the key asset classes that we traffic in, stocks and bonds, to be re-rated, which is another way of saying they went down. And so stocks of the riskier the stock or the farther in the future the earnings were expected to be, the more they got hit. Many of them 70, 80, 90% down from where they were a year ago, when coming out of Thanksgiving 2021, we were expecting no rate hikes this year and, a return to normalization. And then only to find out that the Fed, of course, was way behind and way off in their expectation for inflation coming into this year. And obviously that being a far bigger, longer term, more devastating, intractable problem that has to be, fought with all of the arrows in the quiver, which is what they did this year. The desired outcome of the Fed to slow demand, to get everybody to stop spending as much, and pull back on the pressure of inflation. So what do we know now? Stocks down, bonds down, real estate down, and the consumer, which again is the backbone of our economy, and the persistent desire and ability of the U.S. consumer to keep spending, which had sort of pushed, kept us surging along here with all of the stimulus through 2020 and 2021. Now that appears to be in recede mode. So where does that leave us going into 2023? I think that's the right question to be asking right now, which is, as we have discussed many times, I focus on future earnings and whether or not the numbers that are currently estimated to be earned by the S&P 500 in the future are likely achievable. And in some sense, we can kind of piece together how they might be achievable. We can see certain levers in the economy, obviously unemployment and the direction of unemployment, general inflation, and the price of certain things should give us a clue as to whether or not future earnings are going to be able to be delivered at the level that they're expected. For us, what really matters, sometimes more than what happens, is what happens relative to what's already expected to happen. So it's why we say sometimes things going from awful to less bad can be better for prices than going from okay to pretty good. That movement is generally not enough to be a needle mover in terms of prices in a large and meaningful way. So short story, and we will continue on this theme that we have spoken about before. This earnings expectation for 2023, as we can see here, if this comes across, S&P 500 companies still expected to deliver $2.30 in 2023 and expected to close out this year at $2.18. Any two people can disagree. I would share humbly that number is a pipe dream and extremely unlikely to be delivered, which means that at some point, perhaps as soon as January, these companies will start to mark down their expectations for 2023 earnings, talk down estimates. In the past, that has been a driver of lower prices, not higher, and therefore we maintain defensive positioning going into that episode, which has yet to come. So we have gotten through decent amount of time, tremendous amount of bad news. We're working our way to a more constructive backdrop, but we are just not there yet. And so I don't want to be disingenuous or glib about the setup. And as you can see, the ads in the Longview strategy have been more bond oriented, more fixed income, more cash, and more defensive. And I think that's a fine position. We are certainly going to get out of this year without the calamity that befell many of our competitors and many people. That was not our condition this year, gratefully. And we still continue to hold the line on not on preferring to, not put ourselves in a position to be heroes and be wrong and lose, than be a little bit more cautious about how we proceed into the future. So I think that's sufficient for now. I will once again say happy belated Thanksgiving. Hopefully everybody got to spend some precious moments with loved ones who some of you haven't seen in a long time. I know we certainly had some great times with our family as well, and the kids, and it's always great to see everybody smiles on their faces. And so we go into December. I will check in probably one more time between now and the end of the year, depending on prices and conditions. But I will share my gratitude for, what we would regard yet as another wonderful year with clients and friends, even if the asset returns weren't what anybody wanted. And it looks like it will be too late to salvage it all in December and unlikely to happen. But we're always holding out for unexpected surprises. So who knows? But we like our positioning going into next year. And I will say thanks again, and until next time.